Welcome to the deep dive. Today, we're digging into the latest from America's biggest home builder, D.R. Horton.
That's right. We've got their Q3 2025 earnings call, the press release. Lots of data.
Exactly. And we want to pull out what it tells us about the housing market, how a giant like Horton operates in these, well, choppy waters.
And what it means for you, whether you're maybe thinking about buying or just watching the economy.
Right. Our goal is to cut through the numbers and give you the key takeaways, the important stuff.
Okay, let's do it.
So let's start with the big picture, their overall financial health. The numbers tell a story.
Always do.
For Q3 2025, consolidated revenues were $9.2 billion.
Okay.
Net income came in at $1.0 billion. That's 3.36 cents per share. And their pre-tax income was $1.4 billion, giving them a pre-tax margin of 14.7%. Pretty solid.
Yeah, that's a decent margin, but how does that stack up against last year?
Good point. It's actually down. Revenue dropped about 7% from $10 billion last year.
Okay.
And net income saw a bigger dip, roughly 24% lower than Q3 2024.
All right, so there's definitely some pressure there. But what really jumps out at me is how they're still generating value, managing their capital, even with those drops.
How so?
Well, look at the returns over last year, ending June 30th. Home building pre-tax ROI, 22.1%. That's impressive.
Wow, yeah.
Consolidated ROE, 16.1%. ROA, 11.1%. And here's the kicker. That ROA, it puts them in the top 15% of all S&P 500 companies.
There's just like across all industries.
For the last 3, 5, and 10 years.
Yeah.
It's not just a flash in the pan. It shows, really consistent performance and smart capital use.
That's actually quite surprising. It speaks volumes about their model.
It really does. Plus, cash flow is strong, $2.9 billion generated from operations in the last 12 months. And they're giving a lot back to shareholders.
Right, the buybacks and dividends.
Exactly. $4.6 billion returned over the past year. Just this last quarter, they bought back $1.2 billion in stock and paid out over $122 million in dividends.
So they reduced their share count by about 9% year over year.
Yeah, which helps boost that earnings per share number too.
So all this points to pretty strong financial footing, right? Good flexibility.
Absolutely. They ended the quarter with $5.5 billion in liquidity. That's cash plus available credit.
Yeah.
Total debt is $7.2 billion, putting their debt to total capital ratio at 23.2%. Right around their target of 20%. Very disciplined.
Okay, so financially sound. Now let's shift a bit. What's happening on the ground? With home buyers, this is where it gets really interesting.
Yeah, the demand side.
They closed over 23,000 homes in the quarter. 23,160 actually. Beat their own guidance.
That's positive.
Net sales orders were basically flat compared to last year, around 23,000 homes. The value of those orders dipped slightly, about 3%.
Okay, so volume holding steady, maybe price softening a touch.
Seems like it. Average closing price was just under $378,000, down 1% from the previous quarter, down 3% from last year. Same trend for the average price on new orders. And what about buyers sticking around? The cancellation rate was 17%.
How does that compare?
Well, it's up a tiny bit from Q2's 16%, but actually down from 18% a year ago.
So buyers who sign contracts now seem more committed, maybe better qualified than a year ago.
That's what it suggests, yeah, despite affordability issues.
Which brings us to that key point, affordability.
Yeah.
How are they dealing with that? Because demand is still constrained, right?
Definitely. They said it themselves.
So they've upped the incentives to get people in the door, drive sales.
Right.
And they expect those incentives to stay high, maybe even go up more in Q4, depending on rates and demand.
Makes sense. They mentioned FHA loans being popular.
Yeah, quite a few buyers going that route, partly because of attractive rate offers, like that 3.99% buy down they use sometimes.
But that's more of a targeted thing, like a traffic driver.
Exactly. They said they use it mainly in specific communities. The overall average interest rate on their actual closings was just over 5%.
Okay, that's a more realistic picture. And the buyer profile.
Getting interesting there, too. Average FICO score was 720.
Which is?
Down about 5 points from last year. Lowest it's been in a bit, they said. And the average loan to value, the LTV, that's ticking up, now at 90%.
So slightly lower credit scores, higher LTVs, points to affordability pressure again.
It does. But here's a really big number. First-time homebuyers made up 64% of the loans their mortgage company handled this quarter.
Wow, 64%. That's huge for getting new people into homes.
It really is.
Yeah.
They also mentioned, interestingly, that they haven't seen much impact yet from student loan repayments starting up again.
Okay. Something to keep watching, though. So for someone looking at the market or maybe thinking of buying, what's the takeaway?
Well, D.R. Horton described demand as Choppy.
Choppy, influenced by interest rate swings, economic news.
Yeah, that feels right. But they still have strong ties with real estate agents. Over 80% broker attachment rate.
So they're still reaching buyers, effectively.
Seems so. And broker commissions were pretty stable, costing them about 2.7 percentage points on the gross margin.
Okay. Let's talk about the actual building side now. The nuts and bolts inventory construction times.
Right, the supply side mechanics.
They ended Q3 with about 38,400 homes in inventory. Of those, 25,000 were unsold.
And how many of those were actually finished?
That's the key part. Only 7,300 of the unsold homes were completed. That's way down.
Okay.
And only 800 of those had been sitting finished for more than 6 months. They're moving the finished inventory quickly.
Which ties into cycle times, right? How fast they're building.
Exactly. They've improved cycle times again. It shaved off several days just from Q2 and about 2 weeks compared to last year.
So they're building faster now.
Yeah, they said it's running below historical norms, around 3 months from start to finish.
Wow. So if you can build that fast, you don't need to hold as much finished spec inventory sitting around.
Precisely. Much more efficient.
And what of the foundation for all this? The land. How are they managing that huge pipeline?
They have about 600,000 lots in their position.
Huge number.
But here's the strategy bit. 76% of those lots are controlled through purchase contracts, options basically. Only 24% are owned outright.
Ah, so that's that capital efficiency again. Less cash tied up in land they don't need immediately, more flexibility.
Exactly. They did have some land-related write-offs, about $16 million in impairments and $36 million in dropped options during the quarter.
Which is normal housekeeping for a portfolio that size, adjusting to market conditions.
Right. And they rely heavily on land developers. 66% of their closings in Q3 were on lots developed by third parties or their subsidiary, Forestar. That's up a bit from last year.
Smart partnerships. What about costs? Materials, lots.
Stick and brick costs, the actual building materials, were down a little. About 2% year over year, 1% sequentially.
Okay, some relief there.
Lot costs, though. Slightly down from Q2, but still up mid-single digits compared to last year.
And they expect that lot cost pressure to continue.
Yeah, they anticipate mid-single-digit inflation for lots in the near term. Relief might be, quote, several quarters out. And they flagged that Canadian softwood lumber tariffs are stepping up significantly next month, could impact costs down the line.
Definitely something to watch.
So with costs being a mixed bag, how are they pushing affordability? You mentioned smaller homes.
Yeah, that seems to be a key strategy. They're actively reducing the average selling price, partly by introducing smaller houses on smaller lots.
Got it. Average square footage on closed homes was 1,956 square feet.
Which is down 1% year over year, and quite a bit, high single digits, over the last 5 years. A clear trend.
But they also hinted that getting really affordable needs a little extra help from local governments.
Right. Zoning, regulations. Those can be big hurdles to building smaller, denser, more affordable housing.
Makes sense. An interesting point about the resale market. They don't see it as major competition.
Apparently not. They feel the existing housing stock is generally older.
Right.
And crucially, it doesn't come with those builder incentives, especially the interest rate buy-downs that new construction offers.
So new homes have a distinct advantage, particularly for those first-time buyers they're attracting.
Exactly. It's a compelling package for many right now.
Okay, let's quickly touch on their other operations. It's not just single-family homes, the rental business.
Right. They're big in rentals, too. Generated $55 million pre-tax income on $381 million in revenue in Q3.
From selling rental properties.
Yeah, they sold over 1,000 single-family rentals and around 300 multifamily units. They have big inventory there, $3.1 billion worth.
Mostly multifamily.
Yeah, $2.5 billion multifamily, about $668 million single-family. They're working on improving efficiency there too, but expect lower margins on rental sales next quarter because of the higher interest rate environment.
Okay, market adjustments there too.
And we should mention Forestar again, their land development arm.
Right, the subsidiary.
It sold over 3,600 lots, brought in $391 million in revenue, contributing $44 million in pre-tax income for Horton.
So it's a significant contributor.
Absolutely. And it's tightly integrated. Remember, 63% of Forestar's lots are basically earmarked for D.R. Horton.
Right.
So it feeds their main business.
A really symbiotic relationship.
Totally. And don't forget financial services. Their mortgage arm is very profitable. $81 million pre-tax income on $228 million revenue.
That's a huge margin, over 35%.
Yeah, and handling 81% of their own home buyers' financing. That's massive integration. Land, build, finance.
It really streamlines the whole process for them and the buyer.
Definitely.
Okay, so looking ahead, what's their guidance? What's the outlook?
For Q4, they're projecting revenues between $9.1 and $9.6 billion.
Okay.
And closings between 23,500 and 24,000 homes. Pretty similar pace to Q3.
What about margins? You mentioned incentives might tick up.
Right, so they expect the home sales gross margin to be between 21% and 21.5% in Q4. That's down about half a percentage point from Q3.
Reflecting those higher incentive costs on recent sales orders finally closing.
Exactly. For the full fiscal year, they bumped up guidance slightly, now expecting $33.7 to $34.2 billion in revenue and 85,000 to 85,500 homes closed.
And a big signal of confidence, they raised their share repurchase target for the year.
They did. Now planning to buy back $4.2 to $4.4 billion in stock, up from around $4 billion previously.
That's significant.
Yeah. And they reaffirmed cash flow from operations guidance, expecting over $3 billion for the full year. Strong finish expected.
So their strategy going forward in this, well, still uncertain market.
They seem confident, expecting a solid finish and maintaining a positive outlook for housing medium to long term.
Based on?
Their scale, their experienced teams, market share, geographic spread, and just being disciplined in adjusting to conditions.
Makes sense. They mentioned community count growth slowing down.
Yeah, after growing fast, they see active community count growth moderating to high single digits, then probably settling into mid-single digits longer term.
So more about optimizing the footprint than just rapid expansion now.
Seems like it. A maturing strategy, perhaps.
Yeah.
And they noted that other builders are generally being rational about balancing sales pace versus price.
Meaning no crazy price wars.
Right. Avoiding across-the-board slashing, which helps keep the market somewhat stable.
Okay, so that brings us to the end of this deep dive. Let's leave our listeners with something to think about. Given everything we've discussed, D.R. Horton's strong finances, their big push to return capital via buybacks, this relentless focus on smaller, more affordable homes, what does this signal for the future?
Interesting question.
For large home builders generally, in a market where affordability is likely to remain a major constraint, are we seeing a fundamental shift?
A shift towards what?
Towards driving value primarily through volume, operational efficiency, capital returns, rather than just banking on home price appreciation like in the past? Is that the new playbook for big builders?
That's a really good question. Efficiency and volume over pure price gains is the main engine. Definitely something to chew on.